Hi everyone, welcome back to Be Rich. Happy Sunday evening, and tomorrow is another day for us to see what we can see in the market. As we've been sharing with you in Instagram and on WhatsApp, there are new regulations in place now. Safeguard rails from SEBI. I think they're good. I know a lot of you are upset that there is more throttling on people on social media talking about investing in stocks and shares and whatnot. The SEBI has tightened the noose around this and saying more control is required because there seems to be a lot more loose lips happening on social media. And I agree, it is good because as investors, I rather that we save one life than, and the sacrifice of 100. So there is a lot of, confusion in social media, not only in finance, not only in investing, in all spheres and realms. And that is what's creating a lot of distortion in our world today. So I know, don't be upset about it. We can still manage to find ways to learn, to invest, that is, and find value in the market without being very specific in our discussion. And you know me, I've never been one to be very specific about naming companies or looking at prices. So this suits me quite well. So I understand. For those of you who have been wishing for lists to be given, the famous Patas list, those are not going to be spoken as they were some time ago. That said, a few things I wanted to hit on Sunday this before the week starts is to keep a certain few things in mind as a value investor. One, if you look at the SIP which people are doing for the last year compared to 2 years, let's say you've been investing from 2023 and compared to investing from 2024. So if you take the comparison, there is a huge amount of negative returns coming in the Nifty, in the Sensex, in the next 50. What has been positive is, of course, international funds, because international funds in the arbitrage of the rupee to the dollar, plus a lot of the tech stocks outside India are doing very well. So international funds, I can understand. The sectors which have done well in 1 year's time span is sectors such as technology, pharma, healthcare. And those are the ones my brother has been talking a lot about. And you know his favorite companies in pharma, you know his favorite companies in technology, IT sector. The problem in IT sector is my brother feels a lot of them have bolted the door. So if you look over the last year, the prices have been steadily going up. So most of these have reached a point where we can't find real value in it right now. So we have to wait and watch as far as the IT sector is concerned. The pharma sector is also wholly looking like that. But there are a few companies within the pharma sector which you know about, which we have spoken about in great length, which are hanging pretty low. So keep this in mind. There is value to be found even in markets when it's extremely positive. Now, the flip side of the question would be then a lot of you would say, if this is true, if small cap sector has been correcting a lot, if infrastructure has been correcting a lot, if energy and power has been correcting a lot, why aren't you talking about those sectors? The problem is those sectors right now, the environment within India economically is not conducive for this sector, nor is it globally conducive for the sector because of all the tightening which is going on and the macroeconomic news which is going on. The Indian economy is not doing in great shape. I'm sure you would have seen the budget. This is recorded before budget. So post-budget, I'm sure I'll talk about this more on tomorrow on Monday's video. But even the budget, there's very little the government can do. Like Anand has said, indirect taxes have all been moved to the GST. So in terms of what they really can do anything is in the direct taxes. There, if you do give extra cash in hand to people of a certain category, it really is not going to get back into the economy and start lubricating the economy in terms of flow of currency. And if you look at where else you can get some relief from is the RBI. RBI is trying to do its best without lowering interest rates by trying to inject liquidity, which I spoke about, which is not going to yield the kind of results we want. What we need to see is inflation kind of cool off, which will be very encouraging to RBI. Then RBI might look at reducing interest rates. And of course, the Fed also starts moving their interest rates lower and starts weakening the dollar instead of the dollar becoming very strong. All those prospects right now are not there on the card. So with all this not being there on the card, heavy capex happening, such as infrastructure, energy and power, it's not going to be happening. So it's going to be a little bit of a wait and watch situation in all this. As far as construction is concerned, we saw in the case of DLF, only high luxury apartments and high-end townships are flying off the shelves. Middle income, low income housing are still struggling. because the loans are just not being moving as far as this is concerned, because people are really hurting. So if you look at it like that, in terms of returns, yes, they are deeply corrected, but the correction does not warrant you to go start exploring in these areas. So be careful when you decide to say, okay, I read an article like this, maybe I should go dive into this. I would say no. I would say hold your horses and wait and watch would be my advice. You would be better off to look for companies with value that have a moat and have a good source of business income coming for the foreseeable future, especially if it's dollar, fantastic. So if you've got a company which is earning revenue in dollars, that means from outside India, and it has a good moat, then it's a great company to look at in technology and in pharma. Of course, if it is in value in terms of price to earnings. The other thing which is of interest is ITC hotels. A lot of you are saying, what point do we think ITC hotels will become very valuable for an investor? Well, there also the point is to wait and watch. This would be my reading on this, because I would like to see where does ITC hotels finances come in terms of balance sheet, and I can actually see some workings from the company. So let's see some earnings report, quarter reports, half yearly, let's get on some calls with the management and see what they say, and then see where we can unlock some value for ourselves. Right now, there's no rush, because as far as you're concerned, it's a great brand. Parent brand is amazing. It is owned still by a lot of it, more than 50% is owned by ITC, and not 50%, I think around 40% is owned by ITC. So it is a very good company. And if you have some, thanks to the demerger, you have some in your kitty, keep it. There's no reason to do anything with it. And the rest of it, as far as looking at it in terms of value, I would say wait to see some finances. Let's see some reports, and then we'll take a call. Anyway, when we look at the market and we are buying anything in the market, we are all looking at holding it for 10 years, minimum 15 years. And in those kind of timelines, 1 year, 2 years is not going to kill you. You rather get on the right train than get on the wrong train and land up in the wrong place. So being patient, if you miss a few trains, it's okay. You can catch the next one, would be my advice. The other bit of interesting news is Hindustan Unilever is trying to reinvent itself in India. It let go of its ice cream business, which my brother spoke about. Now the latest thing is they're trying to reinvent themselves by bringing in premium health drinks into their portfolio, and hoping that is going to give them some kind of headwind or tailwind, whatever you want to say. Headwind is when it slows down, I guess. So tailwind would be better. So give it a thrust in the market and give it a kick in its earnings, which is desperately needing. I don't know if it's the right play for Hindustan Unilever as far as health drinks are concerned. I feel it's extremely saturated in India. Everybody is making all kinds of health drinks, and now the question is it really healthy, is what a lot of people are asking. If anything, that should have been done a few years ago. Right now, currently entering the market offering health drinks, even if you're an established brand or you're bringing an established brand, I do not know if it is going to give you the impetus in the market. And what is doing well in terms of health drink is, in India especially, is all natural products and natural drinks, very Indianized things. So bringing in hydration drinks, health drinks from outside India, some big brand into India, and trying to get into a premium segment, I don't know, maybe it'll work, because there is a K-shaped recovery in India and it is a premium product. So maybe, the affluent 18 to 45-year-olds may be looking at consuming this, even if it is at a higher margin, compared to other sports drink, LNG drinks, they might look at it, which will of course help. The fatter the margin for Hindustan Unilever, the happier they will be. So that is something to watch. But the problem with Hindustan Unilever is that, like I've always said, and Anand has also said, is they're a slave to the master. The master is Unilever. And if you are really interested in the business of Hindustan Unilever, you might as well look at the parent. Why look at the child here in India, if you are interested in Unilever's form of business? So that is something else to keep in mind. This is true for a lot of companies, foreign companies sitting here in India, where what they have, the child in India, is only a source of revenue, and most of it is paid in royalty. And after royalty, also they take shares of the profit. So very little is left for the Indian investor in terms of capital appreciation here. So keep that in mind. Nothing else more to say. I hope you enjoyed the video as always. I'm looking forward to catching with all of you up in our Instagram group, in our WhatsApp group, and hope you have a wonderful week ahead of you and hope it's productive. Hope you manage to get some investment done. I hope mainly you do a lot of savings. Like I keep saying, if you feel that you don't have enough to invest, it's not that you don't have opportunities to invest. It is just that you need to stop spending. If you stop spending, you'll have more than enough money to invest. Trust me. So keep that in mind as you carry on with this week. Thanks for watching the video as always. It's been wonderful catching up with you on this Sunday evening. See you tomorrow evening with another video. Thank you for watching Be Rich today. Bye.
Hey guys, that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it, and we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.